There's a provision hidden inside the legal documentation of your bank account that virtually nobody talks about. It's been sitting there for generations, tucked away in the terms and conditions that most people scroll past without reading. Bank representatives rarely mention it unless directly asked, and you won't find financial news networks explaining its significance because it contradicts the reassuring narrative they prefer to broadcast. This provision grants financial institutions the authority to postpone your withdrawal requests for up to 7 days. They don't have to freeze your account indefinitely or deny you access permanently. Just delay it for a full week without providing justification, without triggering alarm bells in the media, and without making any public statement whatsoever. This isn't some conspiracy theory floating around internet forums. It's written directly into federal banking regulations, specifically Title 12, Part 204, Regulation D, which applies to every savings deposit held at banks, credit unions, and thrift institutions across America. The language is straightforward. Financial institutions maintain the authority to demand 7 days advance written notice before processing withdrawals from savings accounts. These aren't my words. They're pulled straight from the regulatory code. The overwhelming majority of account holders never encounter this language because they never examine the detailed agreements they sign when establishing their accounts. Nevertheless, the provision exists, remains fully enforceable, and was deliberately included for specific purposes. This provision isn't merely bureaucratic fine print. It functions as a release valve, a deliberately engineered mechanism built into the banking architecture because the designers of our financial system understood that eventually, under the right combination of stress factors, they would require an instrument capable of slowing withdrawals without declaring a formal state of emergency. They needed something that could operate beneath the radar of public awareness, something that could buy precious time when time becomes the scarcest commodity. What I'm about to explain isn't a catastrophic collapse scenario or a panic-inducing prediction. It's a procedural sequence that begins with legal frameworks most depositors remain unaware of, develops through specific financial pressures currently building on bank balance sheets, and concludes at a point where your ability to access your own funds may no longer be entirely under your control. After years of studying how these sequences develop, I've learned that while the names change, the triggering events shift, and the headlines vary, the underlying mechanics remain remarkably consistent. Once you grasp these mechanics, you stop waiting for breaking news to signal that something has started, because by the time that headline appears, the initial stages have already unfolded. Understanding where we stand today requires examining where this architecture originated and why it was constructed in this particular manner. Consider 1933, when the American banking system was experiencing a catastrophic 3-year meltdown. During this period, more than 9,000 banks disappeared, not weakened, not rescued through government intervention, not reorganized, but completely failed and vanished. Millions of Americans watched their life savings evaporate, not because they spent irresponsibly or made poor investment choices, but because the institutions safeguarding their deposits ran out of liquid funds to honor withdrawal requests. The money existed on paper in various loans and investments, but it wasn't available as cash. Once depositors realized that banks couldn't simultaneously pay everyone seeking withdrawals, the rush began, and that rush ensured the very outcome everyone feared. The aftermath brought a fundamental restructuring of how depositors and financial institutions interact. Congress created the Federal Deposit Insurance Corporation, introduced deposit insurance, rebuilt reserve requirement structures, and embedded specific controls into the legal definitions governing savings accounts. Regulators wrote provisions allowing banks to require advance notice before releasing funds, not permanent denial rights, but temporary delay capabilities. For the following 9 decades, this valve remained largely unused because the system functioned within its design parameters. When runs occurred at individual institutions, they were quickly contained. The FDIC would intervene over a weekend, make insured depositors whole, and the system would continue operating. The valve became like a fire suppression system in a building that's never experienced a fire. You forget it's even there. Then came the savings and loan debacle of the 1980s, which exposed a critical gap in the post-depression architecture. The system could handle individual bank failures efficiently, but struggled with systemic failures cascading across an entire industry sector. Between 1986 and 1995, over 1,000 savings and loan institutions collapsed. The government established the Resolution Trust Corporation specifically to manage the wreckage. Taxpayers absorbed losses exceeding $120 billion, and regulators began designing more permanent solutions for crises too large for the insurance fund alone to address. That solution arrived fully formed after 2008, and this is where the story becomes directly relevant to whatever balance sits in your savings account at this moment. Following the global financial crisis, the Financial Stability Board, the international organization coordinating financial regulation for the world's 20 largest economies, published a new framework for resolving failing banks. The fundamental principle was that bank failure costs should be borne primarily by the bank's own stakeholders rather than taxpayers. This framework became known as bail-in as opposed to bailout. In America, it's embedded within Title II of the Dodd-Frank Act under Orderly Liquidation Authority. The European Union has the Bank Recovery and Resolution Directive. Britain has its Banking Act of 2009. Australia, Canada, and nations across the G20 have implemented variations of this identical framework into law. The Financial Stability Board now coordinates its implementation across 24 jurisdictions worldwide. The specific mechanism operates like this. When a systemically important financial institution enters resolution proceedings, the FDIC or equivalent regulator assumes control. Shareholders are eliminated first, followed by losses imposed on junior bondholders, then senior unsecured bondholders, and finally, if additional capital is needed to restore viability, uninsured deposits exceeding the insured threshold can be converted into equity. Your funds aren't withdrawn or returned, they're converted. You become a shareholder in a recapitalized version of the institution that just collapsed. Your claim on cash transforms into a claim on equity in a restructured bank that may require years to fully resolve and might ultimately return pennies on the dollar. This wasn't theoretical. It was tested in real-world conditions during March 2013 in Cyprus. The two largest Cypriot banks underwent restructuring coordinated by the European Central Bank and International Monetary Fund. Depositors holding balances exceeding 100,000 euros lost up to 47.5% of their savings. Those funds were converted into bank equity. The banks reopened on Monday morning. Depositors who had maintained accounts their entire lives discovered that the rules they believed governed their money had been rewritten over a single weekend. The Financial Stability Board's documentation from the period following Cyprus explicitly described what happened as a successful proof of concept for the bail-in framework. Those words appear in their published records, not hidden in classified documents but openly published. The template was formally established, the framework expanded, and the legal architecture permitting depositor funds to be converted into equity during bank resolutions now governs every major Western economy on the planet. Now let me explain how this connects to our situation in early 2026, because the conditions that transform this architecture from theoretical policy to operational reality aren't hypothetical projections. They're currently sitting on bank balance sheets across the United States, and the data is publicly accessible. As of late 2024, according to data published by the Office of Financial Research, aggregate unrealized securities losses across all FDIC-insured banks stood at $481 billion. That figure represents approximately 20% of the aggregate equity held at banking subsidiaries nationwide. Nearly one-fifth of the entire capital cushion designed to absorb banking system losses exists as paper losses that don't appear on income statements because the assets are designated as held to maturity and therefore don't require market value adjustments unless sold. By spring 2025, as Fortune reported, that number approached $500 billion as the 10-year Treasury yield climbed again, responding to renewed inflationary pressure and uncertainty introduced by the tariff environment. A Stanford finance professor specializing in systemic banking risk told Fortune directly that when the 10-year yield exceeds 4.5%, the banking system begins experiencing serious problems. At 5%, it becomes quite severe. As of now, the 10-year yield sits precisely in that danger zone. This matters because of what Silicon Valley Bank revealed in March 2023, and more importantly, what SVB exposed about structural vulnerabilities shared by hundreds of institutions operating within the same framework. SVB wasn't a rogue operator. It was doing exactly what hundreds of regional banks were doing during the zero-rate era, purchasing long-duration Treasury securities and mortgage-backed securities to earn yield on deposits growing faster than loan demand. When interest rates surged in 2022, the market value of those securities plummeted. The losses remained unrealized, disclosed only in balance sheet footnotes that most depositors never read. But when confidence eroded and depositors with large uninsured balances began moving funds, SVB was forced to sell securities to meet outflows. The moment it sold, paper losses became actual losses. Those actual losses destroyed the capital cushion. Regulators arrived on Friday. By Monday, the bank had ceased to exist. The Office of Financial Research published analysis in May 2025, stating the implication with precision. Unrealized losses could increase banks' vulnerability if other developments, such as substantial surges in commercial real estate loan losses, cause depositors to question a bank's viability. This isn't theoretical speculation. It's a description of what's actively building in the commercial real estate sector right now, which happens to be the segment most concentrated in regional and community bank loan portfolios. Commercial real estate delinquency rates for office loans reached 10.4% in the second half of 2025, approaching 2008 peak levels and representing the fastest rate of increase ever recorded in this data series. Regional banks hold approximately 44% of their total loan portfolios in commercial real estate, compared to just 13% at the largest banks. New loan-level research published in late 2025 found that latent distress in commercial real estate, meaning loans that would be underwater at current property values even if not yet formally delinquent, is approximately 4 times larger than current delinquency statistics suggest. Banks aren't recognizing these losses yet. The practice of extend and pretend, modifying loan terms and pushing out maturity dates to avoid formal default recognition, is masking the true scale. Over $1 trillion in commercial real estate loans were scheduled to mature by the end of 2025, with maturity pressure extending through 2026 and 2027. When those loans mature, borrowers either pay off the balance, refinance at current rates, or default. There is no fourth option. Refinancing at 6 to 8% on properties that have declined 30 to 40% in value isn't economically viable for most commercial borrowers. The extend and pretend window has a hard limit, and when it closes, losses that have been accumulating for 3 years will require recognition. Here's what that recognition event looks like from a depositor's perspective, walking through the sequence step by step, because the order of events matters as much as the events themselves. A regional bank with concentrated commercial real estate exposure begins reporting elevated loan loss provisions in its quarterly earnings. The investment community flags this as a credit quality concern. An analyst publishes a cautionary note. A local financial journalist picks up the story. Within 24 to 48 hours, depositors holding uninsured balances above $250,000 begin calling the bank. Some begin transferring funds. The bank's overnight funding position starts deteriorating. The bank's treasury team activates its liquidity contingency plan and begins drawing on Federal Home Loan Bank advances to strengthen its short-term cash position. One of the tools in that contingency plan is the 7-day notice clause. The bank doesn't need regulatory permission to use it. It doesn't need to declare an emergency. It doesn't need to issue a public announcement. It simply activates a right that has existed in deposit agreements since the accounts were opened. Customers receive written notice. Withdrawals are delayed. The bank has purchased itself 7 days to source alternative funding, negotiate with regulators, explore a sale or merger, or prepare for formal FDIC resolution proceedings. From the depositor's perspective, the notice represents the first visible signal that something is wrong, but the bank's balance sheet stress didn't begin the day the notice arrived. It began months or years earlier, building through unrealized losses, deteriorating commercial real estate performance, and compressed lending margins. The notice isn't the beginning of the problem. It's the moment the problem becomes impossible to manage privately. Let me be precise about the FDIC's actual capacity in this scenario, because there's a widespread assumption that the insurance fund provides complete protection, and that assumption doesn't survive contact with actual numbers. The Deposit Insurance Fund held a balance of $150 billion as of the third quarter of 2025, representing a reserve ratio of 1.4%. That means the fund covers $1.40 for every $100 of insured deposits in the American banking system. Total insured deposits are measured in the low tens of trillions. The fund is sized to handle individual bank failures, but not simultaneous stress events across multiple institutions in the same sector. The FDIC has been transparent about this constraint in its published documentation. The Orderly Liquidation Authority exists precisely because the fund alone cannot address systemic scenarios. In those situations, the resolution process relies on the bail-in mechanism to recapitalize failing institutions using the institution's own liability structure, including uninsured deposits, rather than drawing down the fund. That's why the framework exists. It's the FDIC's institutional answer to the question of what happens when the insurance pool isn't large enough. And the answer is that uninsured depositors become part of the recapitalization. Now let me connect this to the actual mechanics of what sits in your savings account, because the gap between how most depositors think about their balance and how the legal system categorizes it deserves clear understanding. When you deposit money at a bank, you're not placing your funds in a vault for safekeeping. You're making an unsecured loan to the bank. The bank records your deposit as a liability on its balance sheet and deploys those funds into loans and securities. You become an unsecured creditor of the institution with a claim against it for repayment. That claim is subject to the account agreement terms, applicable regulations, and in a resolution scenario, the priority hierarchy established under federal law. For balances exceeding $250,000 per depositor per institution, there's no insurance backstop. You're an unsecured creditor. In an orderly liquidation proceeding, your claim ranks below the bank's derivative obligations, below secured debt, and alongside other uninsured depositors in a recovery process whose timeline and outcome are determined by the FDIC as receiver, not by you. Most people don't think about their savings account this way because they've never had to. The question is how much longer that remains true. The pattern connecting 1933 to the 1980s savings and loan crisis to 2008 to the regional bank stress of 2023 to the current environment is consistent across all of them. Debt accumulates against asset values inflated by the debt itself. The interest rate environment that enabled the accumulation changes. Asset values fall. Concentrated loan books at regional institutions begin generating losses. Depositor confidence at those institutions erodes. The most mobile depositors move first. Their movement accelerates the erosion of confidence for everyone else. The sequence accelerates. What's different in 2026 isn't the pattern. What's different is the legal architecture constructed specifically to manage this sequence once it becomes visible. The 7-day clause, the bail-in framework across 24 jurisdictions, the orderly liquidation authority under Dodd-Frank. This architecture was built after 2008 by regulators who had watched the same sequence play out and decided that next time, depositors above the insured threshold would absorb losses that previously fell on taxpayers. That's not sinister conspiracy. It's deliberate policy choice made publicly, documented in legislation, and in place for 15 years. Most depositors simply haven't read the documentation. Understanding your actual coverage is the starting point. If you hold more than $250,000 at a single institution, the excess is uninsured regardless of the institution's apparent stability. The FDIC's institutional lookup tools are public and free. Spreading deposits across multiple FDIC-insured institutions to remain within the insurance limit at each is straightforward. Understanding that joint accounts and retirement accounts have separate coverage calculations is part of that picture. Understanding what physical assets outside the banking system represent in this context is the second consideration. Gold and silver held in physical form, in your possession, or in allocated segregated private storage exist outside the banking system. They're not subject to the 7-day clause, not subject to orderly liquidation authority, not part of any institution's liability structure. They sit entirely outside the claims hierarchy governing everything else described here. Central banks globally purchased record quantities of gold in 2024 and continued accumulating through 2025. China, Russia, India, and sovereign wealth funds across the Middle East have been systematically building gold reserves. These are institutions with the analytical resources and regulatory access to understand exactly what sits on Western banking system balance sheets. They're not buying gold because they expect immediate collapse. They're buying because they're managing against the tail risk of a system that their own analysis tells them is under structural stress. They're doing exactly what the legal architecture suggests is rational for any creditor wanting assets that cannot be converted or delayed. Silver, trading at a significant discount to its historical ratio relative to gold, faces additional supply constraints from industrial demand in solar manufacturing, electric vehicles, and defense applications. Physical silver demand has been exceeding annual mine supply, and above-ground inventories are at multi-decade lows. The monetary case and the industrial supply case are both present simultaneously, which is an unusual combination. The third consideration is timing and optionality. The decisions above, reviewing your deposit coverage, understanding the legal architecture of your accounts, establishing a position in assets outside the system, don't require an active crisis to justify. They require only accurate understanding of the structure you're currently inside, and they become materially harder to execute once a confidence event is underway at a specific institution because by then the sequence is in motion, the queue is forming, and the 7-day clock may already be running. Bank balance sheets in the United States carry close to $500 billion in unrealized securities losses based on the most recently published figures, representing approximately 20% of aggregate banking system equity. Commercial real estate office delinquencies are approaching 2008 peak levels at the fastest rate of increase ever recorded. Regional banks hold nearly half their loan books in commercial real estate. Latent distress in that sector is estimated to be 4 times larger than formal delinquency statistics currently reflect. The FDIC Deposit Insurance Fund has a 1.4% reserve ratio, above the statutory minimum but not sized for a systemic event. The bail-in framework is legally active across all major Western economies. The 7-day notice clause is sitting in your savings account agreement right now, available to be invoked without external authorization, without public announcement, and without any headline to warn you it's coming. What's not yet determined is the specific trigger, which institution, which earnings report, which commercial real estate maturity default, or which external shock will convert this latent stress into a visible sequence. A Stanford finance professor who studies bank fragility stated it directly in May 2025. The ingredients for stress are still present, especially if macroeconomic conditions deteriorate. He's describing a system that's loaded, not one that's discharged. But a loaded system and an unloaded system require different responses from the people inside it. Let me add one more layer that most financial commentary skips entirely because it explains why this time the sequence cannot be resolved the way it was resolved before. In every previous banking crisis, there was a backstop of last resort. In 1933, it was the creation of the FDIC itself. In the savings and loan crisis, it was the Resolution Trust Corporation funded by federal appropriations. In 2008, it was the Troubled Asset Relief Program. $700 billion in congressional authorization, combined with the Federal Reserve expanding its balance sheet from under $1 trillion to nearly $3 trillion in months. In 2020, it was a combination of zero interest rates, $4 trillion in new Federal Reserve asset purchases, and direct fiscal transfers at a scale not seen since World War II. Each of those interventions worked because the conditions for them existed. The fiscal capacity was available. The political consensus for intervention was achievable. And the starting point before the crisis meant that monetary and fiscal tools had room to operate. The starting point today is different in a specific and measurable way. United States federal debt stands above $36 trillion as of early 2026. Interest payments on that debt are running at an annualized rate exceeding the entire defense budget. The Federal Reserve's balance sheet, even after the quantitative tightening that began in 2022, remains over $7 trillion. The Fed funds rate has been held at 3.5 to 3.75% as of the January 2026 FOMC meeting, with inflation described in the Fed's own statement as remaining somewhat elevated. What this means is that the tools available in 2008 and 2020 have limited room to operate today. Cutting rates to zero again would require the Fed to accept that inflation, which is already elevated, will rise further. Expanding the Fed's balance sheet through new asset purchases would add to a balance sheet that's already historically unprecedented in size. Congressional authorization for another TARP-style program would require bipartisan political consensus on fiscal spending in an environment where national debt and its interest costs are already a primary policy concern. This isn't a prediction that the tools won't be used. Central banks have repeatedly demonstrated willingness to expand their intervention toolkit. The cost of intervention and the cost today is higher than in any previous crisis, which means the resolution is either more expensive, add to the government's balance sheet. The bail-in framework is that mechanism. Its resolution without new taxpayer money. Its recapitalization already on the balance sheet. It doesn't require congressional authorization. It doesn't require the Federal Reserve to print new money. It requires only that the This is why the architecture matters, not because it will necessarily be used, but because it exists. It's the lowest cost. Constraints on every alternative option are higher today than they've been at any previous decision point. The depositor who understands this isn't a pessimist about the structure of the system they're inside. And accurate information acted on before the sequence becomes a public event is the only form of protection that in a vault. Your deposit is a liability on a balance sheet. The insurance protecting it has a cap and a fund with quantifiable limits. The has been redesigned since 2008 to protect the system first and the depositor second, in that order by explicit statutory design. This isn't the end of the sequence. The next data points will arrive in the coming weeks and months, FDIC quarterly banking profiles, commercial real estate maturity data, regional bank earnings disclosures, Federal Reserve balance sheet reporting, and regulatory filings indicating specific institutions approaching the stress thresholds discussed today. The sequence doesn't resolve in a single news cycle, it develops over months. Each stage will be visible if you know what you're looking at. The next development in this sequence isn't a prediction, it's a disclosure that has already been made somewhere in a call report, in a regulatory filing, in a quarterly earnings footnote that hasn't yet become a headline. The only question that remains is whether you're watching this unfold from inside the system without understanding the rules, or from a position you chose deliberately because you read the fine print. The investors and depositors who came through the banking panics of the 1930s, the savings and loan failures of the 1980s, the financial crisis of 2008, and the regional bank failures of 2023 weren't the people who moved fastest after the headline appeared. They were the people who understood the structure before the event, who read the actual account agreements, who recognized that a quiet clause buried in a regulatory definition isn't a footnote. It's a feature that was deliberately designed and can be deliberately used.